Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Craig Martin. Craig is a certified financial planner. He also has all kinds of other credentials that we could list for you here, but anyway, he's a very educated fellow. His company is called the Family Wealth Consulting Group. He is a fee-only financial planner. He provides asset management services, and he's been doing that for about 30 years. And he's the author of a book, Craig Martin, on asset class investing. And if you get in touch with Craig, I'll bet he'll even just send you one of these books. So anyway, but it is a good read, good information in that book. Craig, thank you for joining me today.
Thank you, Mike. It's a pleasure being here. You are doing the financial community a real service by having some of the best financial people in our community come talk with you. So I'm honored to be here and be represented with such a great list of guests.
Oh, well, thank you for that. Well, I'm delighted to have you. And I'll say I'm delighted to have you back. So Craig and I originally did an interview like this some time ago, and decided to revisit it, and part of it is because we're now being shown in many more communities, and also we've learned a lot in the process, so we think that we can do a better job. And so anyway, so our topic today is investing in turbulent times.
Yeah.
And so I'm not going to go into details, but most of us know, we went through a huge market slide, the end of 2008, early 2009, and then we had a huge market recovery. We recovered about 60%, as I recall.
Yes.
And now, and then it keeps going like, and we don't really seem to know where this thing is going. And so consequently, people are just really confused about the whole area of investing, and quite a few, and you may have even more statistics related to this.
Yes, I'll hope to be able to provide some statistics today, Mike, that will help investors understand how safe it is to be in the marketplace over your lifetime.
Okay, so that's a key, and we'll get into that, but this over your lifetime thing is a big deal. But anyway, I mean, so one of the things that has happened is basically, let's just say there's been a huge retreat, a lot of money pulled out of the market. And so I guess the first question that I want to ask is, when you have a volatile stock market like we're experiencing, should I as an investor be sitting on the sidelines?
No.
Oh, brief, huh? Okay, well, why don't you go into a little detail?
Sure. So it is common for investors to look at the short-term returns in the stock market, and because of that, they make short-term decisions. So when the markets go down, they think they can stop the bleeding by sell out and buy bonds, and when the markets go up, they think they can be in it to capture all those gains. Truth is that we don't see that occurs. If during all the studies done by the markets, we see that money goes out as the markets collapse, and by the time they reach the valley of returns, some of the money has left the market, but then the majority of the money leaves the market just right at the valley, and on its way back up, the money's out of the market and not earning those market returns. So money comes back into the market at or near the peak of the cycle. So a way to describe that is the markets go up and the markets go down. Money that is invested in the market comes out at the top, comes out at the bottom, and goes back in at the top. In other words, they're buying low and selling high.
Right.
That's a horrible indictment of the investing public. Average investor on their own without professional help is going to buy low and sell high pretty consistently. Average returns in the marketplace have been 10%. Average returns of an investor in that marketplace has been closer to 2%.
So they're only getting about a fifth of the return that
Yes.
they would be getting.
Simple buy and hold of the marketplace with an index fund is going to produce close to 10% returns. Average investors getting hardly 2% of that.
Not a whole lot better than a bank account.
Probably worse given taxes and
Wow.
effort.
Okay. All right. Well, why don't we talk a little bit about the role of emotions, because that's where it's at as far as what we're
Yes.
talking about here.
Yes.
And so the question is, should we or how do we disregard emotions when making investment decisions, and what is the role of emotions in the process?
Well, emotions are a major part of every decision. There's been a Nobel Prize issued to Dr. Kahneman, and what that psychologist determined is that we use the emotional part of our brain for every decision we make. Some people think they're just logical or just emotional. The truth is we are 100% emotional on all of our decisions. So we may gather a lot of data, but without the emotional part of our brain, the facts are that we can't decide to go left or right, up or down, drink of water or not drink a glass of water. So emotions are critical in our decision-making process. As a human being, it's important to know, because in the investment world, we tend to make decisions based upon our pattern as a human being over thousands of years of training. So we look at two numbers. Last number was down. Today's market numbers are up. Those two numbers give us a direction, and we create a pattern out of them.
Yes.
And that pattern says we should buy into the up market. Or last numbers are here, high, and the next numbers are down. Therefore, all the rest of the numbers are going to be down. So that is a studied pattern of human behavior, and it shows up when I talked earlier about how investors buy at the top and sell at the bottom consistently. They're looking at patterns of numbers and fear and greed.
Yeah.
So emotions are a huge part of the investment world. And as an investment advisor, our job is to help the client not make bad choices based upon their emotions.
Okay. Can you talk a little bit more about fear and greed?
Oh yeah, it's the two emotions that drive the market.
Okay.
Greed is what happens when the markets are peaking. Panic, fear, is what happens when the markets are at the valley of returns. It's in our office we have a phrase that says people buy when they feel good, markets are up. They sell when they feel bad, when the markets are down.
Okay, and so I think a part of it also is, I guess you could say, a little bit of Me Tooism. In other words, people are looking around and they're afraid of looking stupid, if you will.
Yes.
Of making the wrong decision.
Yes.
And so it causes them to sort of go with the crowd.
Yes. Call it the lemming influence. It's what everybody else is doing, so I'm going to do it. They tend to validate their thinking by finding people who agree with their thinking. So if they think the markets are going to go up, they find people that are saying that and make investment choices based upon that. When they think the market's going to go down, they find people that agree with them, so that they can feel good about making an investment decision based upon their thoughts about the future trends in the marketplace. The problem is nobody knows the future. So if anybody tries to predict the future of the stock market, ultimately they will be very disappointed and probably not be one of the highest performing investors in the marketplace.
Okay.